Today is the last day for some of the largest U.S. banks to submit their capital plans to the government. Matt McCormick, a portfolio manager and banking analyst at Bahl and Gaynor, says this is a positive step, but he's only seen fundamentals improve marginally for the industry. He joins us now from Cincinnati. Matt, welcome back to Bloomberg News. Good to see you again.
Nice seeing you, Mark.
Marginal improvement. Why?
When you look at what happened to the banking sector, I'd equate it to Katrina, where you had the terrible storm and now you're in the rebuilding efforts. I think with the TARP plan and the results from the stress test, you're seeing essentially the risk appetite beginning to increase. However, many of this is, in my opinion, a relief rally based upon the substantial fiscal and monetary stimuli that you're seeing in the market. You're seeing some banks that are leading the S&P year-to-date essentially go from $2 to $4. That does not make it a great fundamental buy, but it does show that there is some improvement within the financial sector, but that does not mean we're out of the road or out of the woods yet. You still see interest rates increasing. Right. You still see mortgage refi lessening. The consumer is still being affected. It's not necessarily, it's a better environment for banks, but it's not a great environment.
Well,
Mark.
The financials have enjoyed a pretty nice run recently, haven't they?
Absolutely. They're up about 48% quarter to date and 5% year to date within the S&P 500. Who would have thought that, at this time, as little as 6 months ago, that you would say the financials have been one of the best performers within the market. But again, it is based upon many of these situations, these entities that are relief that they're not going out of business.
Right.
And without the TARP plan, without the stress test results, these banks would be in substantial trouble. I still think some of the fundamentals are weak here.
Right.
And I still think caution is still, particularly for many of these banks, is still the rule.
Matt, what about that government requirement that those banks raise common equity offerings? How's that going to affect shareholders?
Well, the common ones are going to be diluted, Mark, and it shows to me that the government is placing an emphasis on raising capital more so than the common equity shareholders. If you look at 9 of the banks or 9 of the bank entities that passed the stress release or results, 8 of the 9 have already raised common equity when they didn't. The only one who didn't was MetLife, and they have not had the need to do it. Well, Matt, I think go ahead.
No, I'm saying, but there's a possibility we're still facing higher interest rates.
Right, you're already seeing it when you look at the 10-year move from essentially 2.5 up to 3.8 right now. That is certainly signs that interest rates are in front of us, and I think it's something that the consumer is obviously going to be feeling it, especially on the refi area with mortgages, especially if you look at interest rates being somewhat curtailed on, or there's going to be more collars per se on credit cards. The consumer, this is not welcome news for them, and that is, in my opinion, something that does not bode well for the general market.
Matt, there's an assumption that any bank that gets through the government's TARP program cannot come back. Is that assumption misguided?
I think it's realistic, Mark. If you look at what happened with these entities that went through the TARP program, the government is essentially now saying that we're going to give you a clean bill of health. The government, I think, has a duty and obligation to make certain that any bank that leaves this TARP program in its current form does not come back. There is no, once you cross the Rubicon, you cannot get any more money politically, financially, and the average tax holder is going to say, look, we're not you've only gone to the well once.
Right.
And I think when that happens here is that for these entities, the government better make certain that they can stand on their own 2 feet, and if they can, that's great.
Matt, we have about 30 seconds left. What are you buying?
Right now, we're focusing on high-quality companies. We think right now that the market has seen a substantial rise in low-quality shares, and that's usually the playbook that you see coming out of a recession like you saw in 2003. This is not the type of recession we saw in 2003. Low-quality stocks have underperformed year-to-date within the S&P 500. If you see a market rally that continues forward, I think it'll rotate into high-quality names that have been somewhat depressed. I think you'll see some warranted profit-taking in some of these more speculative names. We like companies that have sustainable earnings and a growing dividend, and I think investors are going to see it our way.
Matt McCormick, a portfolio manager, banking analyst at Bahl and Gaynor, joining us from Cincinnati. Matt, thanks.